What if I told you that the market's safest-looking investments are often a trap, and that its greatest wealth creators are hiding in plain sight, completely invisible to conventional analysis? Today, we're diving into the averaging up framework, a powerful new lens for identifying true long-term compounders.
Let's really dig into that question. What if the very metrics we're taught to trust for safety, like high dividend yields and massive buybacks, are actually a smokescreen, a signal of a slow, inevitable decline, all while hiding the most powerful wealth creation engines right under our noses?
To start seeing this trap clearly, we need a benchmark. We need a tool for what makes a business truly great. And as it turns out, that benchmark was identified decades ago by none other than Warren Buffett. It's known as the 15-15 rule, and it's deceptively simple. It defines that exact threshold where a company's compounding flywheel is fully intact. Every dollar kept in the business generates 15 cents of new earnings, which then generates even more the next year. This, right here, is the engine of exponential value creation. But here's the critical distinction, and this is the part that changes everything. The 15-15 rule only shows you the result. You see, two companies can look identical on a spreadsheet, both showing 15% growth. But underneath the surface, the how they achieve it can be radically different. One might be burning through billions to get there, while the other is doing it for free.
So this critical difference in the how leads us to three very distinct categories of capital return. Now, two of them will be familiar to any investor, but the third one fundamentally challenges and in some cases even breaks standard financial models.
First up, you have return of capital. You can almost hear the off in that name. This is where the compounding flywheel is slowing down. The business has run out of high-return places to put new money, so that cash simply has to exit and go back to shareholders.
Second, we have the one we all look for, return on capital. This is your classic compounder. It keeps its cash and reinvests it at high rates to power future growth. The flywheel is spinning fast, fueled by smart capital allocation.
And this brings us to the third and by far the most elusive and powerful category, return on infinity. This is a business that hits that 15-15 growth benchmark without needing to reinvest a single dollar to do it. The flywheel just seems to turn on its own, and as a result, cash overflows.
Now, this creates a major paradox for any standard financial analysis. It's a mathematical impossibility. The return on investment is infinite because the denominator, the amount of new capital you're investing for growth, is zero. Your spreadsheet literally cannot divide by zero, which makes this entire category of business fundamentally invisible to conventional valuation models.
Okay, so how on earth does a business get into this incredible state? To understand that, we have to look under the hood. We can actually deconstruct any business into one of three fundamental growth architectures.
Think of A as the core cash cow and B as the growth engine. In an A-alone business, the hamster is just running on a treadmill, burning all its energy just to stay in the same place. In an A plus B business, the hamster is climbing, but every single step up is expensive. But then you have the incredibly rare A times B architecture. Here, the business becomes what's called a free surfer. It's catching a powerful external wave of growth, and it costs them nothing to ride it.
And once you understand these different architectures, it leads you directly to the first of two powerful opposing realities for any investor, what this framework calls the visible trap. The trap is just so insidious because on the surface, everything looks perfectly stable. Think of a company like Coca-Cola, or even Apple with its massive buybacks. They're returning mountains of cash, but this isn't always a sign of overwhelming strength. It can be a signal that their internal, high-return reinvestment opportunities are actually starting to stall out. So the market sees and rewards all the visible stuff, a high ROE, a stable dividend, a big buyback yield. And investors pay a premium for that perceived safety. But behind the curtain, a slow, invisible decline is compounding. The cash isn't overflowing from a position of force, it's overflowing from weakness. Now, in direct opposition to this trap is something the framework calls the invisible gift. And this is the reality embodied by that free surfer business model, that A times B architecture we just talked about. This is where the real anomaly is. Companies like MSCI or Visa, they seem to break the laws of financial physics. They're achieving high growth while also returning enormous amounts of capital to shareholders. They don't have to choose between growth and shareholder returns, they simply get to do both. So here's the crucial point. The act of returning cash looks identical on a financial statement for both types of companies.
but the underlying realities are polar opposites. One is basically admitting that its growth engine is exhausted. The other is proving its growth engine is so powerful and so effortless, it doesn't even need the cash.
We can actually synthesize this entire framework into a single spectrum, a new gradient really, for evaluating businesses, and it's all based on one critical variable.
This table maps out the entire journey for us. Over on the left, you've got the A alone business where the 15-15 rule is broken and cash just recycles to maintain its position. In the middle, you have the A plus B builder, where growth is real, but it's expensive. And then, all the way on the right, you reach the A times B free surfer, where the 15-15 rule holds at zero cost and cash simply overflows. The one variable that defines this whole gradient? The cost of growth.
Ultimately, what this framework reveals is a structural blindness in conventional analysis. The market charges you a premium for the visible safety of those mature, cash-returning businesses, creating the visible trap. And at the same time, it gives you the zero-cost compounding of the free surfers for free because it can't model a return on infinity. That's the invisible gift. The spreadsheet is blind to the single most important variable, the cost of growth. To explore these investment strategies further and discover more from the collection, visit the website averagingup.com.